Today, I'm going to show you the easiest way, the absolute easiest way to actually beat the market, to beat the S&P 500. Okay. It's ridiculously easy. It's good marketing by investment firms and investment companies. And we've all heard that 90% of Wall Street can't beat the S&P 500, or 90% of active fund managers can't beat the S&P 500. I'm going to prove that wrong today. Very just takes patience. It actually only takes two different investments to beat the S&P 500, but this is the easiest way. And I'm going to talk more about this because I want to really just kill this myth that you can't beat the market, because it's absolutely freaking ridiculous. The first thing that we have to understand about, first, we need to know what's in the S&P 500 in order to beat it. Okay, that's probably just one thing we need to expand our knowledge on. So we all know, hey, it's a diversified index of a bunch of different companies, top 500 companies that are US based, found by sector. Okay. Information technology, which is actually closer to probably about 33% right now, financials, healthcare, consumer discretionary, so on and so forth. Now, I've been a financial advisor for over 20 years. Right off the top, I could tell you that these bottom five, or these bottom four, you don't need it all. You don't need it all. You can cut all of these out, especially if you're a homeowner or if you have rental properties. You don't need real estate. And the reason I say that you can cut them out is because 2% of your portfolio, or 3% here, energy, has virtually no impact on your portfolio as far as the overall returns go. Some people are going to say, well, yes, it's a diversification play and things like that. What you might want to consider, or begin to consider, is that when you're over diversified, you diversify away your returns. You diversify away your returns. And a lot of money managers actually know this. If you actually look at Warren Buffett's studies, especially Charlie Munger, who was the advisor to Warren Buffett for a very long time, Charlie Munger called it diversification. Because if you have a good company and then you pair it with an okay company or a terrible company, you're just going to diversify away your returns. And it doesn't make any sense to do that. You might as well just stick with the companies that are actually going to make you money. When you have 2% of your portfolio, let's say you got a $100,000 portfolio, and $2,000 is in real estate, $2,000 is in materials, $3,000 is in energy, oil and gas. Even if that $2,000 makes 20%, that's $400. $400 on a $100,000 portfolio, you're probably not really either going to miss or even notice, to be perfectly honest with you. It's not a big thing. You do not need these bottom four categories. It's much better to recreate your own index, and double down on what works. Okay. And I'm going to talk about that in a future video, but this one I'm going to keep relatively short, and I'm just going to show you the easiest way to beat the index. And what you really want to focus on are these top sectors right here, because those are the ones that have the most impact on your performance. We're not talking about diversification here. We're talking about your performance, because that's really what this is about. If you can make 15% rather than 10, you're probably going to go for 15, especially if it doesn't really increase your risk profile at all. If anything, the strategy that I'm going to teach you, you get a better return and your portfolio is safer. And I'll talk about that probably in future videos as well. I'm not really going to get into it on this one. Here's the gist of it. 1/3 of your return for the S&P 500 index, if you own VOO or IVV, 1/3 of your return is based on information technology companies. That's where all the money is. They have the best balance sheets. They have the highest profit margins, because software doesn't really take that much money to produce. It takes a lot less money to produce software than it does, say, an airplane at Boeing, or a tractor at Caterpillar, or to run a railroad, or to develop a drug, or to open a brick and mortar store. Anybody can create software. And with the internet, you have a free distribution system to sell and market it in any way you want. Because technology stocks have this really high profit margin, they make all the money in the market. The market is just getting heavily concentrated into more and more technology stocks. Back in 2004, everybody was sounding the alarms about technology stocks because the dot-com bubble had just hit. And that's when technology stocks were 14% of the market. And they're like, oh my God, technology stocks are so overweight in the market, it's 14%. Now it's more than twice that. It's 33%. By 2050, it'll probably be half of the market. Realistically, it's going to be half of the market. And because this is a phenomenon that's not going to stop, because Boeing and Caterpillar and Eli Lilly, even Walmart and Costco, Walmart maybe because they're a huge company, but they really can't compete profit-wise and revenue-wise to the scale of an Apple or a Nvidia. They're just not that size as far as generating those dollars. So those tech companies are always going to have an outsized impact on the performance of your portfolio. Really, all you have to do is find investments that don't have all of the crap in it. Find investments that consistently outperform the market. And everybody's like, well, there aren't any. Nobody can beat the market. That's absolute crap. The first one I'm going to bring up, and this is the first lesson right here. Here's the triple Q. Here's the triple Q. This particular investment kills the market. It kills your return on IVV or VOO. It's just absolutely just there's not a question about it. Almost 380% more than the S&P 500 since 1999. That's huge. When I look at the overall return QQQ versus the S&P, the 10-year total return of VOO is 180%, which is really good. It's really, really good. But the 10-year total return of triple Q is 380%. It's more than double. You have a 10-year total return of 180% versus a 10-year total return of 380%. The averages are astounding. When you look at the triple Q, take a look at the triple Q just versus S&P 500 VOO. Okay. Those are the trailing returns. Here's the averages. 3-year, 16%, 5, 15, 10-year, 13. Not too bad. Those are actually pretty good when we're looking at the total return. And you can go year by year, here are all the returns. Let's just take a look at triple Q. Significantly better. That's why it's complete bullshit when you say you can't beat the market. This thing does it all the time. The 3-year average, almost 22%, 5 years, over 17.5% in 5 years. 10-year, over 18%, and 15 years. So a long track history of beating the market is at over 19%. That's 5% more on each average cycle. The 3-year, 5-year, 10-year, and 15-year. It's at least 5% more on each one of those. Don't tell me that you can't beat the market. That is complete bullshit. This is a Vanguard tool that's available to financial advisors. And what it allows me to do is to input portfolios and compare them side by side. And I'm actually going to set a benchmark here to the S&P 500, just so we can prove my point. Keep in mind, VOO itself actually beats the index. This is something a lot of people don't know, because the index itself, you can't actually invest in. And this is why you get this confusion of, oh, the market does 10 or 12%, because the index, when you're just talking about the index returns, it doesn't include reinvested dividends, just the stock performance of the index when we're looking at the S&P. When you look at the S&P numbers, it does not include reinvested dividends. VOO, however, has the dividends reinvested and compounding if you're set up to do it that way. So VOO just in itself actually does beat the market over time. You don't really see this small 1.5% to 2% improvement. You only really begin to see it after it's usually about 5 years where you begin to see a big difference. But going back to this, what this portfolio is, this first piece is just VOO. Portfolio A is VOO. Portfolio B is VOO, 80% of the portfolio, and the triple Q just at 20. Just not even putting all of it into the triple Q, but just taking 20% of what you would have had. Again, portfolio A, S&P 500, 100% weighting. Portfolio B, 80-20. Very simple. Let's go to parameters to not earliest in common. But for the last 10 years, we could do an earliest in common, but I'm just going to look at the last 10 years just to give a good example. We're not going to do any rebalancing because it's only 2 holdings. We don't really need to. Here's the performance. Let's take a look at this. With this, you're always going to see the first 2 years breaking even. They're just doing the same. And this is where a lot of investors get impatient and they screw up. They don't let the investments work for them and cook for them, because we start this in 2015. We're just even sometimes we're falling behind a little bit because the triple Q is going to be more volatile than VOO, which isn't necessarily a bad thing. You can actually use that to your advantage. But here, you get about 2 years in, and Portfolio B is now $3,000 ahead of Portfolio A, which isn't a huge amount. I mean, it's $3,000. But then you get into year 5. Now we're getting to be about $10,000 ahead, even with these drops. And it's really after that 3rd year where this strategy is going to split off from the trailing index, where you're going to just consistently beat it. But it takes about 2 or 3 years. You got to let it work. You got to let it cook. But this strategy itself, it's about that 3rd year, certainly going into that 4th and 5th year, where there's just a noticeable divide. And it's just because, hey, you're focused on companies that are growing, that have high cash balance sheets, that come out of crises like COVID and 2008 much stronger than what they did before. And so you just see it, you start to get wider and wider. The gap starts to get wider. Then it narrows a little bit. You're always going to see it narrow when the market hits a rough time, particularly in 2022, because tech companies got hit pretty hard. But again, you never fell behind the market. You never fell behind VOO or the index. Okay, so the index is at 256. Portfolio A is at 256. Portfolio B is at 281. Okay. You are a solid 10% ahead. You've got 10% more money than you would have if you just would have bought VO. And that's just with 20% of your money in the triple Q. We'll go to the end. You can't see the benchmark. It's got the S&P benchmark. It's a dotted line behind the blue-green line. But here's where we are at the end. Portfolio B, 80-20 mix, 369. Portfolio A, 333. Okay, you're a full 10% ahead of the index, and it's only going to get better the longer you use this strategy. Let's look at the overall returns. 13.94 versus 12.8. You've got 1% alpha. You are a full percentage point and change ahead of VOO. Don't tell me that you can't beat the market. It's incredibly easy, just even with this strategy. I've got 20 others that I could show you, that I'll begin to show you. But with this strategy alone, you're already beating the market by 1%. Okay? If you go out there and tell most people, hey, I beat the market by 1%, people are going to laugh at you. But whatever. Cumulative return, 233% versus 269%. I know what a lot of you are thinking right now. What if I just put my money in the triple Q? Let's do a comparison. What I did is I just changed it up to where we now have the Vanguard 500 fund VOO versus the triple Q, 100 to 100. And we're just going to edit the assumptions. Again, we're going to go 10 years back. Not going to do any rebalancing because don't tell me you can't beat the market. You're buying the wrong index. All you have to do is switch your index to QQQ and you beat the market. You somehow magically accomplish what 90% of other active managers on Wall Street can't do. And there's a reason why they say that. I'm going to get into that in a second. But again, the first couple years, you're just breaking even. You got to give it that time. I see so many people that are so-called buy and hold investors that every month, every couple months are changing their holdings. They don't even give it 2 or 3 years. You got to get through, if you're going to buy a stock, you got to get through 1,000 sleeps before selling it. 1,000 sleeps and 1,000 wake ups, man, that's barely 3 years. Because if you can't do that, you're a trader, which is fine. You can make money trading. If you want to be lazy about it, be an investor. Those companies will just continue to reward you, and it's a lot less work, and the compounding works so much in your favor in the future. Let's get back to the graph. After 2 years, how far we're 2000, or 2017-ish. Portfolio B is 144 versus 130. We're already getting to be almost 10% ahead of the market, ahead of VOO. Let's get it 5 years. Where are we at? 181 versus 135. We're 50 grand ahead. We are 50 grand ahead of your typical VOO performance. Let me just run the percentage on that. 181 minus 135 divided by 130. Whoops, shit. You are 34% ahead of VOO. In 5 years, you've made 35% more money. Depending on how you're investing, that's life-changing money. It just gets better as time goes on. Again, you widen the gap. And here's the thing. This is what a lot of some of you also have to imagine. If I'm this far ahead, and let's just say this portfolio loses 12%, but the S&P lost 10 that year, I'm still ahead. You don't need to beat it every single year in a row. That's not what beating the market is. You want to beat it consistently. If once you're so far ahead, you just don't fall behind. You could lose an additional 2% temporarily because the triple Q is going to perform better. Let's look at the end numbers. Not a double, but pretty significant. Portfolio A, again, worth $333,000. But portfolio B, just the triple Q, is worth $510,000 in 10 years. You've got more than, that is a huge, huge difference. You've got, let's figure out the percentage here. Oops, 510 minus 333 divided by 333. You've got 53% more return. It's investing with the market with a 50% buffer in there. You got $500,000. Your money has quintupled. We started at 100 grand 10 years ago. You've got a quintuple on your money, a 5-bagger. VOO is not bad. You got a triple bagger, but it's not a 5-bagger. Let's look at the returns. 12% versus over 17.5%. Don't tell me you can't beat the market. They've given it to you. You just have to switch your index. It is that simple. Total return, 233%. Total return, 410. It's really easy to see which one is higher. And I'm not saying you need to build your own portfolio, even though I'll teach you how to do that. All I'm saying is that if you really want to make more money, just stick with the triple Q. It's so much easier to do. I'm going to talk more about this and actually how you can even beat a 17% return. It's pretty easy. But the thing there's one thing I want to stress, and that's this whole thing about you can't beat the market. 90% of money managers can't beat the market. I want to address that. I want to get that bullshit out of the way right now.